The Nikkei just punched through 72,000, up over 1,100 points on the day, and Citi dropped a bomb, calling for 90,000. But right now, every retail trader you know is smashing the buy button, the stochastic is pinned at 96, and the RSI is screaming overbought. This is the exact setup where smart money hunt stops. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today. This is not a report. This is a trader emergency call on the Nikkei 225. We are sitting at 72,353 as of this recording, and the trend on every single time frame, monthly, weekly, daily, 4-hour, 1-hour, is screaming strong buy. The ADX is at 39, confirming a powerful trend, not some exhausted spike. But here's the thing. That same strength has stretched price to a 30% premium above the 200-day moving average, and the herd is now all in. When everybody believes in the melt-up, the liquidity pool for a sharp flush is enormous. So my session bias is this. We are in a roaring bull trend, and the primary plan is to buy dips. But we are not chasing this extension blindly. If you're long here without a clear invalidation level, you're prey. Write this number down. 71,176. That is the exact S1 support from today's pivot, and it's the line that separates a healthy pullback from a bull trap. A 4-hour close below 71,176 and the entire breakout structure resets. Until then, every dip is a buy opportunity, but you must respect that line. The herd positioning tells you everything. Client sentiment just flipped violently bullish as we breached 71,000. At the same time, the Nikkei 225 futures open interest shows a massive buildup of long positions from latecomers. When you see that on top of a stochastic at 96 and an RSI at 74, the probability of a fast, painful stop run back into the 71,200 to 71,000 zone is high. That's the danger zone. The opportunity is that once that flush cleans out weak hands, the trend has months of fuel left. So we position for the flush, then ride the continuation. This dynamic alone separates winners from losers. Let's dive into the technical deep dive. And I want you to visualize the chart as I speak. On the weekly time frame, the Nikkei has just cleared a massive multi-year resistance zone near 71,000. That level was the ceiling from the previous highs, and now it's potential support. The 20-week moving average is sloping aggressively higher, currently around 64,000, and the 200-week moving average is far below. This is a textbook secular bull run. The weekly MACD just crossed into positive territory with no bearish divergence. The histogram is still making higher highs. This means the macro momentum is intact and could easily carry us toward 90,000 over the coming quarters. There is no structural top in sight. The only caution is that the weekly RSI is above 74, heading into overbought, but in a strong trend, overbought can stay overbought for weeks. Now pull up the daily chart. Price is 72,353. The 20-day moving average sits at 68,012, the 50-day at 64,578, and the 200-day all the way down at 56,035. That's a massive separation. The 200-day moving average is acting like a distant foundation, while the 20-day is the dynamic support that has contained every dip in this rally. Every time price has touched that 20-day, buyers have stepped in hard. Right now, though, we are almost 4,300 points above it, so a mean reversion move could be violent. The daily MACD is extended but still rising, no divergence yet. The histogram bars are tall, indicating powerful momentum. However, the stochastic on the daily is at 96, effectively maxed out. The last time it was this extreme, we saw a 3-day sideways to lower grind that relieved the pressure before the next leg up. That's the pattern to expect now. On the daily chart, the immediate support cluster is the pivot-derived levels. S1 at 71,176, S2 at 71,103, and S3 at 71,020. These sit right around the psychological 71,000 handle. That zone is the real test. If it holds, The breakout is confirmed, and the target is wide open. Resistance beyond that is purely psychological. 73,000, then 74,000. There is no historical supply above, so it's a blue sky breakout. Let's drop to the 4-hour chart. Here's what most traders miss. On the 4-hour, the 20-period moving average has been acting as a perfect trampoline for the entire rally. Right now, the 20 MA is roughly around 71,500 and rising fast. The 200-period MA is far below, irrelevant for near-term support. Price is grinding along a steep upward channel, and the 4-hour MACD is still positively stacked, but the histogram has started to lose a tiny bit of altitude. I'm not calling a divergence yet, but if price makes a marginal new high above 72,353 and the MACD histogram fails to follow, that will be a clear negative divergence signal, a warning shot for a pullback to at least the 20 MA on this timeframe. Additionally, the CCI on the 4-hour is at 115, coming off extreme territory, suggesting a short-term cooling is underway. The ADX at 39 tells us the trend is strong, but not so extreme that a deep reversal is imminent. It simply means pullbacks will likely be shallow and bought aggressively. Now onto the 60-minute chart. This is where the tactical entries happen. The 60-minute 20-period MA is around 72,000, and the 200-period MA is near 70,000. Price is currently hanging above both. The RSI on the 1-hour has rolled over from overbought and is now at 68, with a slight bearish divergence. Price made a higher high at 72,353, but the RSI made a lower high. That's a classic momentum loss signal. The 1-hour stochastic is also rolling down from overbought. This is the trigger that tells me a short-term pullback is likely in the next few hours, potentially targeting the 71,800 to 71,600 area, where the 1-hour 20 MA and the 4-hour 20 MA converge. This is not a reversal call. It's the pause that refreshes before the next assault higher. 4-hour trade setups, we'll use this to build a low-risk long entry, and also a counter-trend scalp for the aggressive players. Now let's connect the fundamentals. Yesterday's core news is exactly the fuel for this fire. Citi lifted its Nikkei 225 target to 90,000, citing a tech-led bull market, robust earnings, and foreign inflows. That's a headline that triggers algorithmic buying and FOMO. But what's priced in here? The market is already discounting a perfect soft landing for the global economy and a continuation of yen weakness that boosts exporter profits. The correlation with US dollar to Japanese yen is tight. The dollar-yen holding above 150 keeps the Nikkei bid. If the Bank of Japan even hints at a hawkish tweak, that yen correlation will slam the Nikkei down. So the cross-linkage is, Nikkei's fate is tied to the yen carry trade and Nasdaq futures. Overnight, the Nasdaq closed at a fresh high, and that's feeding into Japanese tech names. The 1 to 2 week directional lean is bullish, targeting 74,000, but it's conditional on holding above 71,176. If we get a daily close below 71,176, the narrative shifts to a failed breakout, and I will flip to neutral with a downside target of 68,000. The key event to watch is any BOJ commentary this week, and US PCE data that could shake the dollar-yen. Do you think Nikkei hit 75,000 before a 10% correction? Comment yes or no. I'm tracking the consensus, and I'll share the results in tomorrow's video. Most people skip the trade setup section. That's exactly where the money is made. Keep watching. I'm going to give you 3 precise strategies, from conservative to aggressive, and after each one I'll flash the exact trade card on screen so you can screenshot it. No ambiguity. No theory. Just levels. Strategy 1. The sniper. Conservative. This is for the patient trader who wants to buy the dip, not chase. We wait for the stop hunt. Place a limit by order at 71,200. That sits right inside the support cluster, just above S1 and S2, and below the 71,500 zone where early longs will get stopped out. The condition: a 1-hour bullish engulfing candle closing above 71,400 after tagging our level. That's your confirmation. Stop loss at 70,900. That's below the S3 support and just under the psychological 71,000 floor. A 300-point risk. Take profit 1 at 73,000, a round number that lines up with the next psychological resistance. That's 1,800 points of potential reward. A risk-to-reward ratio of 1 to 6. Take profit 2 at 74,500, where we'll start hitting the upper channel band. Invalidation. If a daily candle closes below 71,000, the breakout has failed, and this trade is void. Cancel the order entry. 71,200, limit order, stop loss. 70,900 take profit 1. 73,000 take profit 2. 74,500 risk, reward. 1:6 invalidation. Void if daily close below 71,000 strategy 2. The active trader, standard. This is for the trader who wants to ride the momentum on a confirmed breakout continuation, not wait for a deep pullback. We look for a 1-hour candle close above 72,500. That level is just above the current high, confirming that the pullback scenario failed and momentum is accelerating again. Entry on that close. Stop loss at 71,800, which is below the 1-hour swing low that forms just before the breakout, and also beneath the 1-hour 20 MA dynamic support. That's a 700-point stop. Take profit 1 at 74,000, for a 1,500-point gain. Risk, reward of 1 to 2.1. Take profit 2 at 75,000, the next big figure. Once target 1 is hit, move your stop to break even and trail it behind the 1-hour 20-period moving average. Invalidation. If the 1-hour candle that initially closed above 72,500 reverses and closes back below 72,000, the breakout is fake, and you cut the trade early entry. 72,500, 1H close above, stop loss. 71,800 take profit 1. 74,000 take profit 2. 75,000 risk, reward. 1:2.1 invalidation. Void if 1H candle closes below 72,000. Type your Nike target for next week in the comments right now. Let's see who's aligned with the institutional flow. I read every single one. Strategy 3. The Aggressor, high risk. This is a counter-trend momentum fade for a quick pullback, only for those who can lose small and manage risk aggressively. The 1-hour RSI divergence and overbought stochastic suggest a short-term top. We sell at market around 72,350, or better, on a 15-minute bearish engulfing candle that confirms the reversal. Stop loss at 72,900, above today's high and the recent swing peak, a 550-point risk. Take profit 1 at 71,800, which is the convergence of the 1-hour and 4-hour 20. Mars, a 550-point gain. Risk, reward of 1 to 1. This is a scalp against the dominant trend, so do not overstay. If price doesn't drop quickly and instead pushes above 73,000, the trade is completely invalid, and you must get out immediately. I cannot stress this enough. Only take this if you are an experienced trader with a strict stop entry, 72,350, market sell, stop loss, 72,900 take profit 1, 71,800 risk, reward. 1:1 invalidation. Void if price breaks above 73,000 risk management pulse. Never risk more than 1 to 2% of your account per trade. No positions through high-impact news like a surprise BOJ statement or US session data. Stops are non-negotiable. Mental stops don't exist in my world. This is how you survive to trade the next big move. Here's the bottom line for the next session. The single most critical level is 71,176. A 4-hour close below that number and the bull trapdoor swings open, targeting 68,000. Above it, every dip is a buying opportunity for a continued grind towards 73,000 and beyond. Tomorrow's wildcard is the Tokyo Open reaction to US tech earnings after the close and any shift in the yen. If the dollar-yen breaks above 151, it's jet fuel for Nike. If it drops below 149, watch out. I'll be covering the full breakdown on US dollar to Japanese yen and the yen driver in the next video. Tap the end screen now to catch that setup before the move happens. Smash the like button if this gave you a clear plan for today. Subscribe, hit the bell, and I'll see you in the next one. Let's go hunt some pips.